Good day, fellow investors. In this video, we'll analyze deeply Suncor Energy. As I did a few videos on oil stocks, the predominant request was for me to analyze Suncor. When there is a predominant request in comments, this means that usually we have a good business that has some competitive advantage, that has a good dividend even in these bad situations, which means that it offers value, but we have a situation where the market doesn't agree. And therefore, when it comes to retail investors watching this YouTube channel, that's always extremely asked for. So in this video, we'll do a deep analysis of that as you requested. In addition to that, if we take a look at Berkshire's portfolio, Suncor is in the portfolio. If Buffett owns something, it must be great, right? And if you like Buffett, if you like the deep analysis that we will do, and if it offers you value, please click that like button. It means a lot for the YouTube algorithm. Ask questions in the comments, and if you haven't, please subscribe and click that notification bell. Is that all I have to say for YouTube? I hope so. Let's test it. So please do me a favor. Thank you. So it must be a good stock, but the market doesn't agree. Of course, oil stocks were good. Then Russia and Saudis started the war on oil prices, then COVID came, stocks crashed, of course on very low oil prices, then those rebounded, but since then it has been getting worse and worse for oil stocks. We are now at COVID-19 March lows for oil stocks and consequently also for Suncor Energy. But if the dividend is 5.5%, if the outlook is good, if Buffett owns it, this should rebound, right? That's the answer what we're going to try to give in this video. And also the investing takeaways from this video through the analysis that I want to go through are that, especially with oil stocks, mining stocks, you have to always differentiate between businesses that have a finite life and indefinite life. That's very important because then the difference comes in the cash flow valuation and terminal value. Debt, always discuss the debt. When companies have debt, it's riskier. We'll look at Suncor, we'll compare it also to Royal Dutch Shell, and always when it comes to investing, compare the risk and reward and see how it fits your portfolio, because that's what investing is all about. And then at the end, I think I will give you an answer on whether the market is irrational from punishing Suncor so much, or it's simply fairly pricing the risk and reward. Let's start with the business analysis, the fundamentals analysis, make cash flow valuation, investment thesis, and then a quick comparison with Royal Dutch Shell that I made a video also. If I mention some stocks, I'll put the link of those video analysis in the description below this video. So Suncor is an integrated oil producer, so it has pipelines, it has 29-year life of reserve life for production north of Edmonton. If you ever wondered where the middle of nowhere is, it's there. But I also know that Gretzky played for the Edmonton Oilers, so I know something about Canada. Nevertheless, they produce their oil here, transport it around Canada, Americas, so integrated, and most of the money we'll see later they make with their refineries, transportation, and retail operations. They merged with Petro-Canada and the retail gas stations 12-13 years ago, and now they are an integrated business, which is good from one perspective. What do? They do something that's different from other oil stocks. They have in situ and mining operations. They mine the oil, which is very interesting and different than when you see all those drilling rigs. They mine the oil. And the difference is that when you have such an operation, the initial costs, this is the cash flows, are huge to set everything up. But then afterwards they have a long life production, 29-26 years as they said, and very low decline rates, low sustaining costs, medium operating costs, low risks, and good recoveries. A little bit less for in situ, but still okay, compared to offshore drilling and tight oil, which is a little bit different. So very interesting long-term assets there. But Suncor is not a beautiful business for sure, and it is an issue. However, it might not be the issue that plagues the stock. There I read National Geographic article how they have a big negative impact on the environment because the oil mining they're extracting is energy intensive and destructive to the landscape. This is also a big issue there with the waters. This is a water intake pipeline from the Athabasca River, correct me if I am right there. So water, the tailings have a big ecological impact. They are working, or they say they are working on lowering carbon emissions, but most of these plans to reduce carbon emissions by 30% have been scrapped due to coronavirus and saving money, so that might also be an issue. This is how mining looks there. So the bitumen is shallow enough that they can have a mining operation and then refine it at their plants, but yes, it doesn't look nice. And if Uncle Joe wins the elections, he is also against new pipelines, so the Keystone XL new pipeline, but Canada has approved the Trans Mountain pipeline, which should be okay for Suncor to keep delivering their products from the middle of nowhere to the market. That's also another issue for Suncor. Funny thing, the Norwegian pension fund divested Suncor, said it will not own stocks in oil sands producers because of the ecological impact. Probably they forget in Norway that all the wealth they have is coming from oil that has been extracted from the North Sea over the last 50 years, but now they play, oh no, we are green. Yes, good story for kids. Nevertheless, let's look at the fundamentals and what is interesting here. If we look at the fundamentals, this is what they say, that the barrel prices at $35 here, their break-even cost structure, that includes operating costs, sustaining capital, and dividends, is okay with 35. Of course, they have lowered the dividend than what it was last year, but they think that they can sustain that with 35-40. And if we take a look at oil prices, we had 50-60 in 2019, then COVID crashed to minus for a few days also. But we have stabilized around 40, and of course, oil stocks, it all depends on where oil prices go and what the market is pricing in for long-term oil prices. Will it be 40? Will it be 50? Will it be 60? That makes a huge difference, and we'll see later in the valuation. And they say that with current oil prices 35 to 45, they can maintain the dividend that's now go forward dividend of 1.3 billion Canadian dollars, which gives around 5.5%. So we can say that practically in any oil environment they can pay a dividend of 5.5%, which is a good, so you get paid while you wait type of situation, which is also why the stock has been requested so much for me to analyze. If oil prices go up to 60, then they have to increase their investments to keep production. So this means that this dividend is not sustainable for the long term with oil prices around 40, because they need to do more investments to keep production stable. However, if oil goes higher quickly, then they can do buybacks on top of that dividend and invest for future sustainable growth. And this is something investors might be missing, because yes, they can pay a dividend in 2020, 2021, but if oil prices remain low, they will need to invest to keep production up. So they are deferring that investments to keep paying the dividend, hoping that oil prices will go up so that they can catch up on investments. They cancel the wind project, they cancel the lower emission project. So those are all billions that go into the dividend instead of what they promised to do. So there is the balance, and that's something the market might be pricing in. If we have longer, lower oil prices, also this dividend might come into jeopardy. Another sign of what they do is that 50% of their funds from operations come from refining what they produce. So that's also shows how the power of integration. The number of refineries is low in the United States and Canada. Nobody wants a refinery in their backyard, so it won't increase. And that's also an advantage there, as they make half of their money from refining and the other half from producing. However, they also have that key fundamental issue to look at when it comes to any investment. They have 16 billion Canadian dollars, which puts them into the mid-range there. But these 16 billion dollars have to be also implemented in the valuations. Capital allocation has been lowered by 2.53 billion as they save for COVID issues, but this will have to be ramped up somewhere in the future, so also something to think about. We can't take the current free cash flows that pay a dividend as eternal with low prices. Plus, they had now an issue, and this is the guidance that they provided with operating costs for 2020, oil sands operations, 24 to 26 Canadian dollars, which is good, but they had the fire, they had to lower production, delay, do maintenance, and now they have increased it to 28 to 31, which again will impact cash flows, and I think they will take more debt to pay the dividend. So the dividend is safer, but it's not 2019 where they made 5 billion Canadian dollars for investors and invested 5 to 6 billion into operations. However, normal year with oil 55-60, 5 billion is what we can expect for investors. 5 billion on a low dividend, they will have to catch up with investments, but okay, with oil at 60, 5 billion, perhaps also higher dividend, and if that happens, then also the stock will rebound. I have made here a valuation estimating that there will be production, valuable production for the next 20 years. The last 5 years of production, I said, okay, we don't know how will the oil situation look in 2040, so let's say that will be needed to pay cost, dismantling pipelines and everything. With oil at 60 and a discount rate of 8%, they will make, let's say, 1.3 billion in free cash flows this year, 3 billion 2021, and then 5 billion per year up till 2040. The present value of that is, in Canadian dollars, 48 billion if oil is at 30, the market capitalization. Compared to now, it's undervalued by 50 something more percent. If oil goes back to 30, this is what you can expect, and you can expect a double in the stock price, because then the market will start valuing it differently. But what the market is currently pricing in is oil at 50, 20, my calculation 8% discount rate gives me a 23.88 billion market capitalization, which is exactly what the real market capitalization is. So the market now is pricing in oil at 50 for Suncor and likely also other stocks. Therefore, you see the great fundamentals of 2019, 5 billion, but oil was a little bit higher. With oil lower, this is what the market is pricing. And when it comes to rationality, is the market rational or not? We don't know what will happen with future oil prices. We can just assume, see the risk and reward, and then see how it fits our portfolio and investment requirements. If oil stays at these levels, I have calculated that they will pay a dividend for another 10 years, and then they will be in trouble because they need the investments, and then we have a valuation of just 10 billion Canadian dollars. I just quickly deducted the 16 billion Canadian dollars from the payments they need to do, let's say from 2040, to repay the debt they have, let's say, and then that's a long-term outlook, but it lowers a little bit the current present valuation if I remove 16 billion from the end. And this is also the difference between companies that have an infinite life and a finite life. When you know that at some point business will end, then all the valuations are different, because I can't put here a terminal value of 40 billion. That would completely change and add 20 billion here, but I don't know whether Suncor will be there in 20 years. I prefer investing in businesses that will be there, and this increases the betting, so timing becomes a crucial issue. You're going to depend on the OPEC and what they decide. The Fed, recent Dallas Fed research showed that 74% of oil executives in America believe that the OPEC will play a bigger role in the determination of the price of oil going forward. Will they try to destroy producers, shale, etc. first, which might lead to trouble also for Suncor, and then increase oil prices, or they'll increase oil prices immediately so that the others survive? We will see. But one thing is sure, and this is perhaps the investment thesis you can play on, is that oil prices will certainly be very, very volatile, and we are now in the lows for the last, 2 decades. So oil prices 33, 26 low, 2016, 40, 2020, September 30. We are here now, but oil prices have also been much, much higher. Is it the end of oil? Not yet. Oil will be in demand for the next 5, 7 years, 10 years, surely, and then we'll see how it goes. So if oil rebounds like it does often, and it will likely rebound if things improve, then Suncor will probably double, because the market will not be pricing 50, will start to price 60, because the market always thinks short term, what's now, they just extrapolate from that into the future. And these are the irrationalities we as value investors have to take advantage of. The only problem is you have to implement the timing component into your portfolio allocation. Okay, it's not an eternal investment, it's a well-calculated risk-reward bet that I'm making now. Comparison to Royal Dutch Shell, link in the description below of the video. So this is very important for me. Suncor, and this is probably also why Buffett bought 20 years of production ahead, Royal Dutch Shell just 8 years. Market capitalization is equal, so what is this? 20-something% free cash flow with oil at 60. So the market is valuing them equally, but not differentiating for this. The debt also 3 times good cash flows. This is 4 times good cash flow. So Royal Dutch Shell has more debt on a shorter lifespan. They will have to invest to recover, to replace those reserves. They invested 70 billion in BG few years ago, and that didn't help much. So it's extremely costly to do this. Therefore, Suncor is a good business, does have an advantage. On eco-friendliness, sustainability, it's the same, but Royal Dutch Shell has better PR, better management, and they sell a better picture. And then this is in Nigeria or who knows where, not in your backyard. In the north of Netherlands, they are scaling down. This is in your backyard, literally, so this is more discussed. So when it comes to Suncor and the key takeaways, yes, among the oil players, it's a better company because of the long-term lifespan, but it has a lifespan 20-25 years, so it will likely take advantage of those ups and downs, and that is gives you more safety, a better margin of safety if you're going to play the ups and downs. However, there is also the debt part, which is risky, because if there is a longer period of time with lower oil prices, with lower cash flows, then the debt becomes an issue. And you can see how that works. So Marathon Oil Corporation, as oil price is not as expected, simply the stock is going down, and this is the timing issue. This is the risk of betting on oil, and this is also a risk you have to implement in your portfolio exposure to these kind of stocks, because you never know what can happen. Also, California Resources files for bankruptcy because their plan was to have oil at 100 when it was pinned off from Occidental, and when the debt was pinned off. That didn't happen. That actually crashed here, so the company didn't manage to meet expectations, and we all know what happened to the stock price. So these are the risks reward. That it's borderline with Suncor, it's more risky with Shell from my perspective, and therefore Suncor is a better bet even than Shell, but it's still a bet. Whether the market is rational or not, oil at 50 are they assuming long term? We haven't seen stable oil at 60 and above over the last 5 years. There are less investments, less capital investments. There might be an oil demand issue, supply demand issue in the next 3 years. When things return to normal, they will likely return to normal. Then we might see oil at 60. Again, the market then using 60, 70 as an average over the long term. But that's also just estimations that fit a probabilistic risk-reward analysis, and you have to see how that fits your portfolio. More bullish on natural gas because I see a better long-term outlook for that despite the renewables, trends, and ecology, because we need to balance things and you can't simply build windmills all over the place. So there will be a place for oil to play on the ups and downs, on the volatility, and that's the best I can think of when it comes to stocks like Suncor. Is Suncor better than Shell? Yes. Thank you for watching. If you like this, please subscribe, and I'll see you in the next video.